a day of absolute financial Armageddon in global financial markets. Bad has become worse and worse has become horrible. It could clearly be one of the toughest days in last couple of years if you take the COVID part aside. So as of now, markets are falling like it is in bottomless pit. We all know the news. We all know the factors. The fear, in a sense, for the first time in this bull market is haunting the bulls. For the first times, the bears have an advantage. Now let's look at the market mood index. Now the market mood index, which is a combination of FI flows, activity, is still, surprise, in the greed zone. So I'm not going to spend much time in understanding and explaining the market mood index. Let's understand the most important aspect, which is volatility. Volatility is a short-term measure of which way markets are headed. It is measured in VIX. And for those who are the millennial investors, I would like to remind them, this is often a risk indicator. The volatility index right now as we speak is in the red zone, which is 30 plus. Now remember the number of 30 plus. Historically, when the volatility has gone to 30 plus, what has happened immediately after that? Remember, volatility does not go to 30 plus or stays above 30 plus for an extended period of time. And if you keep the COVID sell-off aside and the GFC crisis aside, volatility has not stayed at these levels for a long period of time. I'll tell you what, we'll talk about volatility right now. But before volatility, what we are going to do is that since everybody is talking about war right now, we've gone down the memory lane and looked at how markets have moved historically when wars have happened. Now focus on the first part, that's the Gulf War. When the Gulf War happened, 1 month after that, Sensex appreciated by 13%. When the Bosnia conflict happened, 1 month after that, the Sensex was down 12%. And when the Kosovo conflict happened, a month after that, the markets or Sensex was up by about 10%. If I put slightly back and analyze how gold has moved, well, the correlation is very, very simple, which is a month after the war, markets, they tend to go higher rather than lower. So remember this data point. It is a warlike situation. Will it be a military war? Will it be only economic sanctions coming from the Western power? We don't know yet. But if history is a benchmark, anything to go by, every time a warlike situation has happened, a war has happened, a month after that, markets, they tend to go higher. So today, what you have in terms of the market assessment, it's a lot of red on the screen, but a month from now, will it be staying there? That is the most important part. Now, Mark Mobius is getting ready. I'm just going to go to Mark to get his sense on where he's investing in this world right now. But before that, I also want to remind some of our viewers that while we may look at the test and the fall in the market, 20% on the bank nifty, 15% plus on the nifty, historically every time when markets have fallen in a bull market, what has happened? So it is not for the first time the strength of the bull market is getting tested. The strength of the bull market has also got tested in a lot of previous occasions, and we'll show that data point. But Mark is ready. He's smiling as always because Mark loves bad news. The reason why he loves bad news is because he's able to invest when there is bad news. So Mark, am I right?
That's
you are loving
right,
because
exactly.
prices are looking good.
Yes, it's a good time to invest when things are down. Of course, that doesn't mean that things are not going to go down further, but still, now is a good time to start thinking about seeking the best bargains.
Mark, in your experience, and you've got almost 3 decades of experience, it is not for the first time we've seen a war-like situation. But historically, for those who bought when there is a war-like situation, when there's a geopolitical crisis, do you think the rewards are in favor of going long, or the rewards right now are in favor of conserving cash?
Probably going long once the market comes down further. Of course, this is just the beginning. I believe that you'll see markets come down. But interestingly enough, not all markets are down. Of course, India in its downside has actually outperformed the S&P 500, but some markets like Saudi Arabia, Brazil, are actually up. We have to pick and choose which markets look interesting and which markets will not be so affected. But nevertheless, those markets that are affected, that are down, now's a good time to start looking for bargains.
So Mark, what will be the turning point for this market? Will it be geopolitical? Will it be Fed? Or will it be pure prices? Because Mark, there are times when events do not change, but prices, they go down so much that markets, they start to factor in a lot of bad news. So at this juncture, what to your mind are financial markets pricing in?
Well, one of the things that you have to be careful about in India and also in the US is the rise of interest rates, because as you know, the Reserve Bank will probably want to raise rates in India in view of the higher inflation problem. So given that situation, you have to focus on those companies that have low debt or no debt, because those are the ones that will survive this crisis. And those are the ones that will pay very good rewards in the long term. So I think it's very important to pick and choose and not just take any big stock, any index stock, but look at those companies that have strong balance sheets and of course are growing earnings as well.
Mark, so let's address the 4 factors which are bothering Indian markets. First is geopolitical. What is your assessment? How much of the geopolitical scare is in the price?
Well, from a geopolitical point of view, if you look at India and Russia, India is not dependent upon Russian oil, as you know. And also, India, despite all the concerns about global warming and so forth, has lots of coal. So if necessary, India can depend on coal rather than oil or gas. So in that sense, India has a lot of flexibility going forward when you look at commodity prices. But then you must remember that India is still growing at a torrid pace. The growth rate in India this year would probably be 7 or 8% even. So even with these higher fuel prices, which is a dampener in some industries, not all, then you're going to see good growth in India.
Mark, the second factor which is bothering Indian markets is that how world is adjusting to a higher interest rate regime. So after the recent sell-off and adjustment in high P stocks locally and globally, how much of the Fed hike or how many Fed hikes are already priced in?
I think a number of Fed hikes are already priced in, but people will probably be surprised that interest rates in America, at least, could go well above 7%. I know this sounds very high, but it's happened in the past. If you look at inflation rates in America, now it's 7.5%, and the central bank is going to want to bring that down. And they believe, probably wrongly, higher interest rates will bring inflation down. And that means those companies that are vulnerable, that is high debt companies, are going to be in trouble.
Mark, the third factor bothering India is this relentless selling which is coming from institutional investors. Now, if the India story is so strong and earning visibility is around the corner and Indian markets have corrected to reasonable levels, why are FI selling? Is it more compulsive in nature or this is India-specific factor?
Well, it's a natural reaction on the part of investors around the world, including institutional investors. They pull back. They see markets coming down. They say, oh, I better get out and wait until the bottom is reached. So you're seeing that not only in India, but in other parts of the world, the US and so forth. S&P is down more than the Indian index. So people are pulling money back everywhere.
Based on Swadesh, 3 stocks in India. Are you tempted to make that 4 or already you made your 3 stocks to 2 stocks in the sell-off?
We hold the Indian stocks. We're not selling them, that's for sure. And with enough downside, in other words, enough of these movements downwards, we'd probably buy more.
You're so excited about India, Mark. I mean, we've interacted for a long period of time, so maybe I know the answer already. But for the benefit of our viewers, you're curious to understand because some of them are shaken up when you see so much of relentless FI selling.
Yes. This is what normally happens in these critical situations. When you think about it, Ukraine is far away from India, but they're affected by the psychology of crisis. So you've got to really think about that and consider how much is this crisis really going to affect India? And I would say very, very little, except in the case of oil prices. But we knew that oil prices were going up anyway because inflation in America is going up at such a rate that the prices of oil must go up as well.
Where is oil headed according to you? And what is happening in oil? Could that fuel inflation more structurally? Could that have impact on other commodities as well? Because suddenly if the energy cost in the world will go higher, it will start impacting more than demand, supply, and the raw material cost.
Well, all commodities are up, as you know. You can look at silver, palladium, platinum, gold, and many other commodities are up. And that's a reflection of inflation. In other words, the money printing presses in America and other parts of the world has resulted in the devaluation of currencies. And that in turn means higher prices because someone who is mining for coal or mining for gold, his costs are going up as a result of this inflationary impact. So you can expect all of these prices to move up and reflect the incredible increase in money supply that we've seen.
I remember reading a book of yours which talks about inflation is not going to come back and the world will have to live with low inflation for a long period of time. That thesis is getting challenged. It's getting challenged because of a variety of factors. Easy liquidity, sudden uptick in prices, freebies which have been given by central bankers. So what happens to this adjustment process? Because world was prepared for low inflation for long. Now it's going to be high inflation for short time.
You know, the good news is technology is having the effect of pushing costs down. So you have two things that work. On the one hand, you have the devaluation of money because of the increase in money supply. On the other side, you've got technology coming in and pushing the costs of goods and services down in many, many areas. And of course, you know, you can find many examples of that in the world today. And this technology impetus is going forward very, very quickly. That's the reason why I talk about the wonderful world of deflation. Because at the end of the day, despite the devaluation of currencies, you're going to see a deflationary impact in the long run. So we're actually in a pretty good shape when it comes to investing in equities, because we're investing in companies that are able to adjust their prices to the rise in inflation.
What is the future, Mark, for the hyper-growth stocks? I'm referring to Indian tech companies which went public, the US tech companies which have got smoked in last couple of months. Is world now running away from what was called as a hyper-growth economy?
I think they have to turn away from companies who are growing in terms of headcount, in terms of clicks and so forth. You know, the tech companies always talk about how many clicks they're getting on their sites or how many customers they're growing and so forth. That was great when interest rates were zero or near zero. It's no longer great because as interest rates go up and the cost of money rises, cheap money for these companies is not going to be available. So that means these companies that have debts or are dependent upon cheap money will be in trouble. That's the reason why I advise people when looking at tech companies, look at the balance sheet to begin with. How much debt do they have? And then look at the return on capital, look at the profitability. If they don't have a high return on capital, then they're going to be in trouble as interest rates rise. So a lot of these hot stocks that went IPOs will be in trouble.
Mark, 3 months from now in hindsight, when we will talk about February 2022, will that be the best buying opportunity perhaps this bull market will give, or will this be the best buying opportunity of the year?
Not yet. I wouldn't say that it's a good idea to rush into the markets yet, because markets are still adjusting to what's happening. But I must say that there's no need for you to exit companies that have strong balance sheets and are growing earnings and have pricing power. pricing power is very, very important in this kind of environment because it means that a company that has its pricing power can raise their prices in line with inflation. And of course, competitors that are not able to do that will be in trouble.
Mark, once the geopolitical concerns are behind us, do you think markets will come back to, let's say, Jan end levels, February beginning levels, or that level is unlikely to come back given that Fed normalization will continue to haunt us?
Well, the previous peaks will be surpassed. There's no question in my mind that the peak that we've seen in the Indian market, in the American market, in any market around the world, any equity market, by the way, let me emphasize that, not fixed income, but equity market, those peaks will be surpassed. There's no question in my mind that this will happen, simply because equities are adjusted to inflation. And if you could look at the record of indices of equity markets, you'll see they've always surpassed the previous peaks.
Mark, so just to put it very simply, your view is that the Indian bull market is not over?
No, I'm talking about a long-term bull market in India is certainly not over. There'll be corrections, there'll be problems along the way, but the bull market is not over, that's for sure.
Can India do relatively better, or it will do absolutely better in a world which is falling apart? Why I'm asking you this is that can India decouple itself with what is happening to global financial markets?
Well, yes, if you look at, just look at India, the Indian index and the S&P 500, the US index, you'll see that India has been outperforming. And going forward, I believe they will continue to outperform simply because the country is growing at such a high rate. 7 or 8% is high, very high growth. So there's no question in my mind that the market will do very well.
Mark, what is the biggest risk for this market? Would you say it's Fed, valuations, or is it geopolitical still?
I think the biggest risk in the Indian market is slackening of the efforts to reform. The Modi program, as you know, is very much oriented towards reform and the imposition of technology into the economy. And the degree to which that is successful will be very, very important for India. The degree to which there's a slackening of that effort will not be good. So I would say keep an eye on these reform movements, keep an eye on the privatization of state-owned enterprises in India. All these reforms that Modi has introduced are extremely important to the future success of the country.
Mobius, really appreciate your time. So glad you could join us. It's a hard day. Long-term investors, I'm sure when they will look back, they would call this as a blip in the overall bull market. But the problem is that when markets they fall, the entire selling is so concentrated that it is really shaking the very core belief. Now, in equities, remember, corrections are par for course. Volatility will always happen. Like they say that if you cannot feel the heat, you should not be in the kitchen. Today it's a bad day, but I'm reasonably confident given how dynamics are moving, what will happen because of the geopolitical situation in terms of the medium and the long-term implications, what will happen to earnings of IT and banks, what will happen to earnings of some of the FMCG companies, barring the short-term adjustment, I think it's not going to be large. I mean, we've survived COVID. The world has evolved to something like COVID. So even if there is going to be geopolitical tension, crude stays above $100, adjustment will happen. Adjustment in the financial markets happens always fastest. Adjustment in real life takes some time. We are getting a sense from the MEA that there is a serious possibility that OPEC could be looking at increasing production. US has indicated that they are looking at increasing their oil reserves to bring oil prices down. So a lot will happen, a lot will change. But today, it's a bad day. If you are a long-term guy, 6 months beyond, 1 year beyond, if your outlook for 3 to 5 years, I don't think anything changes in your life. Now that's the market cap erosion. Look at the market cap erosion. HDFC Bank, Wipro, HDFC. It's just, whichever way I look at it, left, right, center, it's absolutely a sea of red. I mean, for a market which 3 months ago, there was a feeling of carnival, now you're getting a feeling of mortuary. Whatever may be the reason, the bottom line here is that markets today have got small. Let's take a quick break.